All right, let's kickstart the first conversation of the day. And we recently spoke about passive investing and the ways that you can consider investing in index funds and ETFs. Now, this is a concept that is related to that in a sense, in that it is essentially passive investing, but it is passive investing with a twist. I'm talking about factor investing, or as it is called in several places, smart beta. Joining me to talk about this is Santosh Navlani, who is the COO of ET Money. Thank you so much, Santosh, for taking the time, and good evening to you. First, let's start with what factor investing is, what is smart beta, what was the origin of it, and what is its history here in India?
Yeah, Alex. One of the easier way to understand factor investing would be basically finding the difference between active and passive, and where does the factor investing fit in. So we are all aware what active investing is all about. It basically means a fund manager who is actively looking to identify sectors which are going to benefit in the future, near future, immediate future, depending on the horizon of the investment that the fund manager has, and identifying bottom-up stock picking approach or any other methodology that the fund manager may employ. And the objective is very simple, that a fund manager has a benchmark in mind, and the fund manager tries to outperform the benchmark. So if the benchmark is Nifty for a large cap fund, the fund manager works towards creating investment strategy, identifying sectors, stocks, and investing in a way where the fund manager is able to deliver better returns than what Nifty can give over a period of time. On the other side, when we look at as we realize a lot of active funds, be it across large cap space and now emerging into mid cap space as well, they're not able to outperform their respective benchmarks, and that's where passive investing is becoming popular, has become very, very popular for large cap space, is getting popular in mid cap space as well. And passive investing is very simple to understand, that instead of trying to outperform the benchmark, which becomes very difficult over long periods of time consistently, one becomes satisfied by just saying that let me earn the returns of the benchmark itself, and if I continue doing that over long periods of time, then I will probably be richer. And that's where passive investing falls into place, where there's no intent to outperform the benchmark at a very small cost that a index mutual fund can launch a passive fund, or one invest in that. So passive investing is all about mirroring the returns of the index, and active is all about outperforming the index. And factor-based investments actually combines best of, at least tries to combine best of active and passive, wherein instead of having a fund manager who is tasked with identifying the sectors and stocks, the factor investing approach is basically on a simple principle that let me invest in quality stocks. So the factor will be about what basically qualifies a quality stock. So it can be EPS growth, it can be gross margin improvement, it can be operating revenues growth, it can be debt to equity ratio or financial leverage, it can be return on equity, return of capital employed, any kind of factors which four things somebody can combine and say, if the thresholds beyond certain levels are met in a specific stocks, it classifies as a good quality stock, and I will identify these 15, 20, 50 quality stocks and invest passively in them, and actually generate returns that a fund manager cannot generate. And we can extend the understanding of this approach as factors of quality to factors of low volatility, factors of dividends income, factors of momentum, factors of alpha. So there are multiple areas or multiple ways to identify some kind of mathematical formulae which can be consistent, unemotional, very, very unbiased way of investing, and can produce returns which are as transparent as an index and at a low cost as an index, but having an approach which may be able to give you better returns over a passive investment. So it combines best of both worlds, and it's pretty interesting and exciting area over the last few years in the country. And I think a lot of products are coming in the space which are quite interesting to look at from long-term portfolio creation perspective.
It certainly has caught the fancy of investors, and certainly the AMCs are not shirking that responsibility of adding more products. There has been a burgeoning of these schemes, right? So how many schemes are there right now?
I think about 25, 26 schemes in the marketplace right now, and maybe more to come, Alex. But the number of schemes may sound big. There are actually about 4 to 6 factor-based investments available in the marketplace, which are prominent today. So one of them, which has recently caught the eye of the marketplace over the last 1.5, 2 years, is momentum as a factor. So there are a couple of options available for investors with a fund from UTI, another fund from Motilal Oswal, and an ETF by Motilal Oswal as well, which is actually the same index, which is Nifty 200 Momentum 30 index, which means that it identifies top 30 stocks which have best momentum score out of the Nifty NSE 200 as a universe, and only investing in them via formulae, by a predefined methodology, and reviewing that 30 stocks every 6 months, and just holding that in the same proportion. So what it does is identifies top stocks on momentum score, which basically means price return over last 6 months and 1 year, and it's divided by the volatility. The better the score, the higher the score of momentum, the more the weightage that stock gets. And it basically means you are actually identifying stocks which are in demand by the market participants, which are expected to do well in the eyes of market participants. So instead of applying mind and method to figure out which stock I should buy the stocks which are actually gaining in price as of now. And this approach of investments actually has worked pretty well over last decade or so in India as well. And globally, it has been a proven methodology of identifying good investments. There are another factor of something called as alpha, which has recently been launched by a product of Kotak, which is Kotak Alpha 50, which only identifies top 50 stocks based on alpha score, based on Jensen's alpha as a statistical methodology. And it takes universe of top 300 stocks. The difference between momentum and alpha investing is the alpha factor is determined every quarter. So you basically change the stocks over every 3 months, but the 50 stocks you identify each quarter, you hold on to them. And I can go on and add multiple methodologies of low volatility, alpha and low volatility coming together, value as a factor where you identify a value with some kind of methodology which is consistent and not biased and subjective. So basically what happens is you actually have different ways to create portfolios based on momentum, low volatility, alpha, value, quality, and you can actually pick up and choose 3 or 4 factors and create a good diversified portfolio, which may do better than the active funds and may do better than passive funds, or you can basically fall somewhere in between where you don't feel the pain that you underperformed an active fund, but you basically feel that you almost outperform in a passive fund as well. So it's a good balance which these factor funds bring in the table, and I believe it's time that investors should probably look at this category seriously.
You've described a few already, but there are a few, in fact, that would make this even simpler, I think, to understand, which is, for example, the equal weight, right? If you look at the Nifty 50 and you look at the 50 stocks, and we spoke about this yesterday when we discussed index funds and different types of index funds. We spoke about the Nifty 50 index fund, and we spoke about the fact that the Reliance Industries has a very large share of that Nifty 50 index fund. What would the benefit of holding an equal weight Nifty 50 be then, Santosh?
Yeah, so Alex, I wouldn't classify the equal weight funds as really factor fund, because they tend to factor means basically I identify some kind of methodology and I follow that. And equal weight is very simplistic approach to investments where I tend to avoid as a fund manager, I avoid concentration risk in my portfolio, and instead of relying on market's judgment about what kind of companies are more valued more compared to others, which reflects in the weight of the stock in the index. I basically say that let me not be biased and allocate like a small percentage equally split across all the stocks in index. So when you look at a Nifty 50 equal weight index, which actually means your 50 stocks in the index, instead of allocating 13% to Reliance, 8% to HDFC, so on and so forth, where I think top 10 stocks in Nifty 50 index fund today almost account for 58% of the weightage in total, which basically means that you are very concentrated, having a very concentrated portfolio. And if you go deeper and see, a banking sector actually has almost 35%, 36% weightage in the index, where you basically are so much overexposed to a single sector. So it might sound risky in the short term to any investor. And one of the ways to avoid that is investing in a Nifty 50 equal weight index, which basically means that you put 2% each in all 50 stocks, and you basically go to 100%. And what happens is, it becomes a very simple rule book that the moment a specific stock appreciates in value so much that the weight in my portfolio becomes 2.2%, I'll load off the 0.2% book profits and come back to 2%. Again, if a stock falls off, corrects and becomes 1.8% in my portfolio because of market price correction, I will sell the winner and buy more of the loser, and get this 1.8% to 2% again. So what happens is, over a long period of time, if you compare the returns of the equal weight and Nifty, they are more or less similar. But there are periods of outperformance in equal weight, like what we've seen last 2 years, because there is a bull market and a secular rally in the marketplace, where all stocks almost appreciate in almost a very unprecedented manner. And that's where an equal weight index gives you a very strong thing, because if you look at a Nifty, the 50th stock like Shree Cement has very fractional weight in the Nifty 50 index. And even if you're holding Shree Cement and Shree Cement runs up a lot, I will not probably benefit as a fund manager, as an investor. And when you have 2% allocation to Shree Cement and that appreciates a big number, I add alpha to my portfolio. So equal weight basically means, instead of applying mind, I just divide the entire thing into equal proportions and invest. It can be Nifty equal 100 as well, where I put 1% each in all 100 stocks. So it's not a factor in my opinion, but it's a good way to approach investments and make it more simple than the index can for you.
Got it. I got it. Now, there is data to suggest that over the long time, or over the long term, this kind of investing, factor investing, has the potential to beat the market. But if you look at experiences, Santosh, in certain other markets, in the US, for example, some of these factors have fallen out of favor. Do you think that we'll need to wait for a little longer, maybe give it a few more years to come to an absolute conclusion that this is something that on a very regular basis is able to beat the market? Or can we say that right now?
So I think, market is always unpredictable, Alex. So one cannot say each factor will outperform or perform in every kind of market scenario. So there'll be times where a specific factor might perform really well, but at the same time, it may not perform in near future again. And we can say that very confidently about, look at momentum for that matter. So it did really, really well in later part of 2020 and a large part of 2021. But towards the fag end of 2021 until now, the momentum has not worked, and value has outperformed. So imagine that you are a fund manager, a typical fund manager who is actively managing and outperforming the index would probably have kind of made some tweaks in the investment strategy in last 6 to 9 months, where the allocation to value stocks would have gone up in his portfolio, in his or her portfolio, and the allocation towards growth stocks would have gone down. Same thing should happen in real life for investors following passive factor investing approach as well, where if you are holding a lot of money in momentum as a factor, then you need to really review, because you cannot put all money in one factor or majority of your money in one factor. You probably, if you are building your portfolio, the way you diversify across large cap, mid cap, small cap, different fund houses, if you're doing actively managed funds, should approach the same way as well, that you should have some money towards quality, value, momentum, low volatility. Depending on risk appetite, you can decide what 2 or 3 kind of factors will dominantly form your portfolio, and keep reviewing based on market scenario and based on your asset allocation, how you should be approaching it. So I wouldn't say that every factor performs at all point of times. There are times for each factor, each strategy, as is the case with different sectors and market caps of the market. So this is not They sort of escape the reality of market, that markets are always volatile, and in the long run, returns always tend towards the mean. And this is what will happen in factor investing as well.
Certainly, there is no magic bullet or silver bullet to help you get past things. There's no get rich easy strategy. It requires analysis. Very true. But there are some very clear advantages or benefits to choosing factor investing. What are they?
So I would say they typically are very similar to what passive investing's advantages are. First of all, low cost. So because there is no human being or a fund manager or a team of research analysts identifying the stocks and sectors, there is no personal cost involved, and hence the expense ratio of these factor funds typically tends towards similar to low cost index funds, a bit higher. So like 30 to 40 basis points, most of the funds will be available in the marketplace today. Second aspect is transparency. So you actually know how the investing strategy is going to be. So for when you're investing in an active fund, a fund manager, based on the market situation, may change the approach compared to the time when you evaluated the fund to invest in. At that point of time, maybe following growth strategy, but because of market scenarios, it may go towards value because of fund managers' bias or analysis, whatever it may be. And you may get surprised if it underperformance comes in. But when you're investing in factor-based approach, you would know that a momentum is going to be momentum-based investing in 2010, 2015, 2020, 2025 as well. When you buy a quality strategy, factor-based fund, it is going to be quality all the time. So transparency is number two, as I mentioned. And number three is basically no human bias at all, wherein the same stock can actually be momentum at some point of time, and but after certain correction it may become value. So the factor based approach is not biased that this stock is supposed to momentum and should not come in this index anymore. It's all about mathematics and numbers and formulae, wherein a Tata Motors, for example, if it's part of momentum for a long time, and I wouldn't know, but it may have been part of value at some point of time in 18, 19, 20. I wouldn't be aware, but it is possible. So basically, you are not biased or married to stocks and classifying them as one approach. They can keep changing based on market scenario. And of course, you basically get a very stable experience where you don't need to review your portfolio just because the market is changing. If you have a bunch of 3 or 4 factors for long-term investments, you would know that 1 or 2 of them will probably find favor in the marketplace and not stay out of favor for a long time.
I'm quite confident that Tata Motors, when it slipped into double digits, was a consensus buy, and so it's safe to bet that it was in fact value at that point of time. But having said that, there are drawbacks to this approach as well. As in the case of any approach, while there are benefits, there are drawbacks. So what should the investor bear in mind?
So it's the drawback is simply that you cannot be getting over-indexed on certain type of investment. So, for example, if you're investing in a factor which actually is taking, say, Nifty 100 or Nifty 200 as universe, then if the kind of factor you're investing in has a large overlap between two different kind of funds, and you may approach as a diversified strategy, it may not turn out to be one. So if, for example, the universe of, say, a Kotak Alpha 50, which is top 300 stocks by market cap, and it's falling alpha as a way of identifying stocks, and there is momentum, which is NSE 200 universe and top 30 stocks by momentum score, there will be times where both some stocks will be classified as alpha stocks as well as momentum stocks, and there may be overlap. So putting all the money in a same kind of universe with similar kind of methodology may not be right. So if you're holding an alpha strategy, a momentum may not be right thing for you. You may be better off by putting money in a quality, for example, that point of time. If a stock is giving you large exposure to value, then you can look at growth as a factor, another thing. So diversification or lack of one can be a drawback if you don't really plan your portfolio properly, is how I would put it. Otherwise, I don't really see a disadvantage in a passive investing approach, because passive is all about holding it for long term, looking at your asset allocation, and actually kind of sticking to investment plan for long term.
Okay, I think that more or less covers all of the aspects of this. One last point: if somebody is new to this space, what is the kind of advice that you would give them? Because people are now, even as we speak, cutting their teeth on passive investing strategies. That can get a little nuanced. This is perhaps a step further in that direction. So, what advice would you give people who are just about starting?
So I would say, don't put all money in factor. Start small. If you are somebody who is actually following an active investment approach and putting money in actively managed funds, then maybe passive is a better choice, which is market cap based passive investments. I know complement your investments with that. But if you're somebody who's shunning the active management route, as many people are, then it may be better that you have index-based passive investments, and complement that portfolio with factors. So, for example, I can choose that. Let me put money in Nifty 50, Next 50 as my large cap universe, where I'm going to buy all the 100 stocks effectively and indirectly by holding these two indices. I actually complement that by buying a Nifty 100 quality 30 index, which actually will give me some kind of focused approach towards quality stocks. Or for that matter, if I buy a kind of momentum as a strategy, which is top 200 stocks, top 30 stocks coming from there as momentum score, I complement that with mid cap quality 150. No, sorry, mid cap 150 quality 50 ETF of DSP, for example, or UTI index, which has a similar approach there. So I complement this momentum in a mid cap approach for my large and mid cap, and also have a large and mid cap market cap based index funds. So between these two, I can indicate what an actively managed fund performance would give me, or maybe somewhere fall in between active and passive, and I will probably be better off as investor on the cost, transparency, ease of management.
I think that wraps this conversation up very nicely. Santosh, thank you so much for taking the time. Always a pleasure speaking with you.
Thanks, Alex.